I'm Charlotte McLeod with investingnews.com, and here today with me is Steve Penny, founder of silverchartist.com. Thank you so much for being here. Great to have you.
You bet, Charlotte. Thank you for the invite. I've been watching your channel for a long time. So excited to be a first-time appearance on your channel.
Oh, well, thank you so much. I have been watching you for a long time as well, so it's great to be speaking to you finally. I was thinking, I'm familiar with you. I think many of our audience members will also be familiar with you, but just because it is our first conversation, I thought we could start with just a brief introduction to yourself and the work that you're doing right now.
Sure, yeah. Steve Penny, founder of silverchartist.com, and we are laser focused on silver, uranium, gold, and platinum, as I believe they present very compelling opportunities. I would say the most favorable risk reward setups over the next, let's call it 5+ years. And I like to say fundamentals tell me what to buy, but technicals tell me when to buy and when to sell. So we do have that deep fundamental conviction in each of those kind of focus sectors or metals. However, we use technicals to, identify higher risk reward setups, great times to buy, and we're not afraid to push the sell button. So we focus a lot on strategy over predictions. We do have forecasts, but we also focus a lot on maximizing risk adjusted returns. A lot of people, especially newer investors, tend to focus on, hey, what's my upside potential? Well, we kind of like to measure upside potential versus downside risk and put strategies in place to maximize risk adjusted returns.
Well, that's a great introduction. And maybe we could talk a little bit more about how you strategize there, because I know it can be easy to buy. It can be quite hard to sell, and getting in and out of the market is something that investors might struggle with.
It sure is. And I think, everyone should have a personalized strategy. And just because, it should be personalized, crafted to your own risk tolerances and objectives and all those kind of things. But I think a simple way to do it, and I'll just tell you how I do it. I have physical metals stored outside of the banking system, and some of which is set aside as a generational insurance policy against these out of control central planners and central bankers. Some of it, because I've been accumulating for a while, some of it I will eventually sell when using a ratio-based exit strategy. But any kind of paper positions, I have one portfolio that's for long-term that I'm willing to hold through the inherent volatility that's just wild in these sectors. And then I have a separate account. So by compartmentalizing different accounts, it allows me, I give myself permission to push the sell button in the separate dedicated account when we get overbought against resistance, just like we were. We took profits and exited all our silver miners right the day before this most recent peak. So we give ourselves in that bucket permission to take profits when we get short-term way overbought against resistance, and then we scale back in when we're oversold against support. But if we're wrong and it just keeps ripping to the upside, well, I keep a long-term portfolio that I'm not trying to trade in and out of, not trying to get too cute. So that's just one simple strategy, compartmentalizing different accounts where you have different rules and different objectives within different accounts.
That's really interesting. So you do have your different baskets, and I can see how that would allow you to do things with one part of your portfolio while leaving the other alone. And you had mentioned the ratio that you might be looking for. So I've been hearing a lot more about gold-silver ratio lately and where it could be going. What are you looking for there to take you to that point where you might be willing to sell some metal?
Well, I use a lot of ratio charts to determine when I'm ultimately going to sell. I'm talking about the end of the precious metals bull market. So a couple of big ratios I look at is the Dow to gold ratio. Back in 1980, the Dow bottomed at 850. Where did gold peak? 850. So that's a 1-to-1 ratio. Now, I'm not going to wait for a 1-to-1 ratio, but we start getting down to like a 3-to-1 ratio. It might be time to start, divesting some gold and scaling into what other undervalued assets in general equities. By the way, I apologize for the car alarm just started going off in the background there. So Dow gold ratio is one. Another one is real estate to gold ratio and real estate to silver ratio. There was a period in 1980 where you could trade around 1,000 ounces of silver for the median home price in the United States. Right now, it's several multiples of that. I think it's north of 10,000 ounces you would need for the average median home price in the United States. So that's another ratio. You mentioned the gold to silver ratio. Typically, that peaks in gold bull markets. That peaks around 15-to-1. Back in 1980, it was about a 15-to-1 ratio. In 2011, that ratio got to 30-to-1. As back in 2020, it got down to 60-to-1. So right now we're north of 80-to-1. So silver is a much better value proposition, in my opinion, than gold. But I don't necessarily look at that gold-silver ratio as like a timing indicator to exit the sector, but more as you can use ratios to your advantage. So like back in April of this year, platinum was trading at a historic extreme relative to gold. You could trade 1 ounce of gold for 3 ounces of platinum. Typically, platinum is more expensive than gold. So I'll use those ratios of one metal to the other to kind of swap when we get to extreme, historic extremes, but not necessarily to time like the end of a bull market, which, by the way, I think we've got a long way to go in these bull markets.
Okay, that helps me understand a lot better what you're doing, and really good to take a look at your strategy. We'll get into some of those individual metals, and we will focus on the ones that you are looking at most closely. I thought to begin with silver. So as you mentioned, in the last few weeks, we've seen silver get up to all-time highs. And even though right now we're in a pullback, it seems like we have more staying power at this level than we have in previous times when we've seen silver up this high. So I think people are looking at this, and I hate to ask is this time different, but where are you seeing silver in the cycle right now? Maybe we could phrase it that way.
Well, I think we're in the middle of a major bull market. Obviously, everyone and their brother knows $50 is a key level in silver. 1980 was the all-time, or we got up to almost $50 in 1980, again in 2011, and here we are knocking on the door of 50 again. We briefly got up to like $54 a couple weeks ago. Here we are back down to 48. So there's a key battle going on at 50. Now you can make a bear case and a bull case over the intermediate term here. So I like to say strategy is greater than predictions. But I think there's a very good likelihood that we consolidate, if not pull back. In silver, I'm looking at major support down around 40, down to 35. So when I look at the long-term chart for silver, the monthly candlestick chart has this big, long upper wick. And we're speaking here on Friday, October 30th. So it's the last trading day of the month. We're green today, but there's that long upper wick. So you could make a case that it was a false breakout above 50 because it looks like we're going to close the month back below 50 with this long upper wick, which would indicate we likely need a period of consolidation, if not pullback, before moving higher. Now, the bull case is if you look at a big, long, like 40-year chart for silver, there's this massive cup and handle pattern. A lot of people have posted that on social media. I don't know if you've seen that one. But that gives a measured move target up to $96. And you can make a case that we're in the middle of staging a major breakout. So not to give kind of speak out of both sides of my mouth, but I think probabilities suggest a pullback here, consolidation. And me personally, I'm looking to buy the dip if that does come to fruition, because I do think we're headed up towards triple digit silver. That long-term pattern, by the way, gives a measured move target from a technical perspective of about $96. And I think we're ultimately headed there in, let's call it the next couple of years, if not sooner.
Well, I think that answers where I was going to go next with that, which was long-term price outlook for silver. So that triple digit is something that could happen. Of course, right now, I wondered if you could talk a little bit more about how you played it when silver went to that $54 level, because I think that could be interesting to take a look at.
Sure. Yeah. I mean, how we played it, we had one chart. I mean, I'm not going to show it now, but there's on the long-term chart going back to, I believe, 2008, there's this rising bearish wedge pattern. And every time we got up to the upper rail of resistance, we've consolidated and pulled back. And every time we got down to the lower edge of support, we bounced. And we've been using that chart as our roadmap to $50 silver. So we had been projecting a move to 50 this fall. Now, remember, I have different buckets or portfolios. So in that volatility bucket, once we got to 44, we're just kind of gradually, slowly scaling out. And then, a little bit of luck there that we're able to fully exit in that particular bucket the day before that interim peak, just because we got so extreme overbought. The COT is bearish. We haven't gotten a commitment to traders report in a few weeks because of this government shutdown. But, the banks are positioned for a pullback in silver. You've got a lot of euphoric optimism. And also, there's a chart that not many people are talking about, the long-term chart for the US dollar going back to 2008. Now, I am fundamentally bearish on the dollar for sure. However, from a purely technical perspective, there's a heavy short position in the dollar. Almost no one is expecting a bounce, and we're sitting right at the edge of long-term support in the dollar. So I would not be surprised at all to see a bounce in the dollar here. So taking profits, I think, is just part of good risk management, because these sectors are so volatile, and volatility can be used to your advantage. So if you've got cash available, bring on the pullback. If you've got, who does a pullback bother? It's the people who have no cash available. They're fully invested at all times. Well, then those pullbacks are very painful. But if you've got cash available, you can embrace that volatility to the downside and upside.
Yeah. We always hear that silver is so volatile, but I can see how you can use that to your advantage. And maybe we can talk a little bit more about how you use fundamentals and technicals and put them together. Because I know when we were having silver going up to that high level there, we were looking at also what was going on in London. There was all this talk about a market squeeze there. So when you see things like that going on, how are you weighing it into what you're doing? Or is it more you've got the fundamental case and then you start keeping in mind the technicals? How does that work?
Yes, such a good question. So I think to speculate, invest in these volatile sectors, you do have to have a deep fundamental conviction, because otherwise your emotions are going to allow you to, or prompt you to sell near the lows at the worst time. However, I've been saying for years, and anyone who's been following silver and gold for a long time knows this, that there's very likely many claims of ownership on every ounce of silver and gold in the commodities exchange and the LBMA. That's been known for a long time. And, I like to say that the bullish headlines are loudest at interim peaks. So, we knew this for a long time, that there's multiple claims of ownership, there's physical stress. It's just now everyone's talking about it, and that's fully, from my perspective, the charts were suggesting that's fully priced in because people know that. And, that can be resolved by higher prices. So yes, I don't want to dismiss those supply issues over in London. And I think that's totally true. However, I think when we're up near $54, that news was fully priced in at the moment.
Yeah, I can see what you mean there. Very, very interesting. And so we've taken a pretty good look at silver. I'm wondering if we can look at gold as well. We have kind of a similar situation where we had gold go up to all-time highs. We're in a pullback right now. So I'm wondering what you can say about what the charts are telling you about gold. Maybe we talk about support and resistance levels there.
Sure, on gold. So I think you also asked about ultimate price targets too and fundamentals. And an interesting anecdote is if you take the average of the last two big bull markets, the 1970s bull market and the bull market from 1999 to 2011, I call those the last two. Well, the average return in gold over those two bull markets was about 15x. So if you consider the start of this bull market, January 2016, after they cut rates for the first time, raised rates for the first time in years, that marked the bottom in gold. It was $1,045. So if you just take the average of the last two bull markets, 15x, that gives you a logical price target around $15,000 gold. That may seem outlandish here, but $4,000 gold seemed outlandish 2 years ago too. So I think in the fullness of time, $15,000 is likely to be achieved. Now, we are extreme overbought right now in gold. If you look at the monthly chart, that monthly RSI, that's just a measure of how overbought something is technically. It's the most overbought it's ever been in all of history, even more than it was back in 1980. And every time we've approached this level, or almost every single time on that RSI, it's taken a few years of consolidation before making a new high. Now, I don't expect it to take a few years to make a new high. However, I do think it's very likely to take a few months to possibly even a couple of quarters before making a new all-time high in gold. And that's healthy. That would be healthy to churn sideways, even pull back. We got up to 4,400, I think 43.98 was the intraday peak. So 20% pullback would be a pullback to $3,500. I'm not necessarily predicting that, but it's well within the possibility that we pull back to 3,500. And if that were to happen, I think that would be a fantastic opportunity. I think we're more likely to go to down to 4,000, between 4,000 and 3,500 than we are to shoot straight up to 5,000 or 6,000. I think we need that few month consolidation period to kind of work off some of the overbought conditions for some of the weak-handed momentum chasing speculators who don't really understand the fundamentals to be shaken loose and build a new base before moving higher. Ultimately, I think we're going much higher, but I think it may take a little bit of time here.
Yeah, I think that 3,500 level for gold is something that I've been hearing as we go into this correction time as a place where it could go. And of course, that would be a buying opportunity. So makes a lot of sense to me. And, I'm wondering if we could talk a little bit about who is in the market right now. I think you had maybe mentioned there's new people in the market who might have come in when the price was really going up. Maybe they need to be shaken out. So are you seeing more participation from the average person in this market at this time?
Yeah, I do think there's been a lot of newcomers to the market who maybe don't have a deep understanding of the fundamentals for the metals. They just see things moving up. They see relative outperformance. That's a reason we look at the Dow gold ratio, because when gold is outperforming the Dow Jones, generalist investors, high net worth individuals, institutions, trading algorithms all start to gravitate towards gold. But as soon as it stops going up or consolidates, those people lose interest and they go to the next kind of shiny object. So I think those people do need to get shaken loose. And often too, when you get kind of an interim peak like this, there's kind of two cohorts of people. So think of silver. 90% of the move tends to happen in the last 10% of the time. It took a few years to go from 20 to 30. And then it took longer to go from 30 to 40, but it went from 40 to 50, over 50 in just like a handful of weeks. So that move was really fast. And I think as that move was happening, there were probably a lot of people on the sidelines saying, I want to get in, but they're waiting for a pullback that never happened. So often what happens, you get the first pullback, and that's the opportunity for those people to jump in, and it often causes a price jump. Now, you've got a separate cohort of people who are often way overweight the sector and never push the sell button at all. And then they saw this sharp sell-off and they say, wow, that was scary. I wish I sold some. So they often sell into strength. So what I'm looking at now, my baseline scenario is that this is kind of a dead cat bounce in silver up towards 48, 49, and then I'm looking for lower lows. That's my baseline scenario. Now, take forecasts with a grain of salt, right? Strategies are greater than predictions. I know I keep saying that, but that's my baseline outlook right now, is that we're getting a bounce in silver, gold as well, and then I think we're going to see lower lows in the weeks and months ahead.
Makes a lot of sense to me. And we've been talking about gold and silver, the metals themselves, but I'm curious about how you integrate gold and silver equities into your strategy.
Sure. Yeah. I like to say that I think people who are new to the sector should start with physical metals stored outside of the banking system as an insurance policy. I look at it as an insurance policy against these out of control central planners and central bankers. The mining stocks add risk, but they also add leverage. But I think that's the order to go in, is first start with metal and then start introducing some high quality blue chip, mining stocks or royalty and streaming companies, which I think are even better. And I would start with long-term holdings and then, work your way down to the riskier sectors. And what I'm trying to say here is I made this mistake 15 years ago when I first got into the sector, is people want to get rich quick and they go straight to they build a portfolio of penny stocks, and many of them are going to probably go to zero. I think the reverse order is how people should do it. Physical metal, then high quality blue chip stocks that you just be right, sit tight, hold for the duration of the bull market. After you've got that core position, then you can go down the risk curve a little bit, down the food chain, and use volatility to your advantage, take on a little bit of extra risk with money that you can afford to lose.
Well, yeah. And I was going to ask you, where do you see the most opportunity in the gold and silver stocks? Where might people be able to make those big gains? But it sounds like that might not actually be necessarily the way to play it.
Yeah, remember in the beginning I said it's a risk-reward ratios. Most people focus on upside potential. Yeah, there is potential for 10x or 20x or even more returns in those penny stocks, but the downside risk is you can lose all your money. So I think there's much more. To me, here's the sweet spot is mid-tier producers with exploration upside, because the dilution risk is reduced because they're producing, they have cash flow, so they don't have to necessarily dilute their shares and take on all kinds of extra debt. But they've still got exploration upside. So that's kind of a sweet spot. And also you mentioned, what to consider in the mining space. I look at ratios of, senior gold miners, junior gold miners, senior silver miners, junior silver miners, and look at ratios against each other. And right now, the junior silver miners are still the most undervalued component of the whole precious metal sector. And by the way, that bodes well for, that's not typically how bull markets end in precious metals. If this were truly the end of the bull market, what you would expect to see is the junior silver miners leading the pack and overvalued relative to everything else. But the opposite is true. They're still the most undervalued component. Something to consider too is a lot of people go, they want to pick the individual. It's very difficult to outperform just an index. So there's nothing wrong with the ETFs. Like if you want junior silver miners, there's nothing wrong with SILJ. You get a nice basket of individual stocks, diversified geographically, and you don't have to. If you're new, you don't have to go become a stock picker. Just having exposure to the sector, it can be a smart way to do it.
Yeah, I think that's a good reminder for everybody there. And I want to also look over at platinum for just a moment, because I know it's also one of your areas of focus. And it's kind of an interesting situation where the price was range bound for so long, and then we started to see a breakout this year. So I think as we look at gold and silver, everybody is also wondering, all right, what is next for platinum? So what are you seeing as the outlook here?
Yeah, I'm very bullish on platinum, and I think platinum has the potential to even outperform silver. Not necessarily predicting that, but it's got the potential to do it, although it does carry more risk. So for me, I've got about 20% of my physical metals in platinum, and I feel good about that because it's got the potential to outperform, but it's also a little bit riskier. I used to say silver is the only commodity on the planet that's about half of where it was at its previous all-time high. Well, platinum, the all-time high is $2,300, so we're sitting around $1,600 platinum. Not quite half, but still way below its previous all-time high. So from a fundamental perspective, platinum is extremely undervalued. Also, when you look at platinum versus silver and platinum versus gold on a ratio basis, historically extreme undervalued compared to those two metals. And, platinum is such a tiny market that it doesn't take much investment demand to really move the price. So when platinum goes, I think it's really going to go. Part of my exit strategy with platinum, I think it's important because it's so volatile, is to begin swapping it for other metals like gold and silver when the ratio dictates. Just like I swapped some gold for 1 ounce of gold for 3 ounces of platinum back in April, I think there'll come a time where you can swap 1 ounce of platinum for 2 ounces of gold. We've gotten to that ratio where platinum was twice the price of gold 2 times in the last 20 years. And I think we'll probably go in there again.
Well, and I was going to ask what your preferred way to approach platinum is. And it sounds like it's the physical metal. Is that the main way that you would encourage people to go into it?
It is. I like the physical metal. As far as mining stocks, it's really hard to find high quality platinum stocks, especially that are like pure play platinum miners. Sibanye-Stillwater is kind of a big one. Not the best run company in my opinion, but it does give you exposure to platinum and palladium. But I prefer the physical metal. And then there's a couple of ETFs. Reluctant to mention this one, but PPLT, it's intended to give you exposure to the price of platinum. Not a bbig fan that the custodian is JP Morgan, so people can have their problems with that. Another one is the Sprott Physical Platinum and Palladium Trust, SPPP. I own that one personally. It's 50% platinum, 50% palladium. I'm more bullish on platinum, but I'm also bullish on palladium as well. So that's another one to consider.
Well, thank you for going into those ones. And just because you mentioned you're a little bit bullish on palladium, I'll ask you about that one because I've been bringing it up to people as we talk about the potential in gold, silver, platinum. And it feels like most people are more lukewarm on palladium and not so sure about it. So maybe just briefly, if you could share your thoughts on the market.
Sure. And I don't claim to be an expert in palladium. I do know more about platinum than palladium, so I don't want to get in over my head going into the details of the nitty gritty of the fundamentals. However, using those ratios, right, platinum is still undervalued relative to palladium historically. Both metals are used in catalytic converters, in internal combustion engines, gasoline and diesel. And platinum was kind of, I believe there's a substitution effect going on because for a while there, palladium was more expensive than platinum. So you saw in the Chinese import numbers over the last year or two, they've been importing a lot more platinum than palladium. And, if palladium's more expensive and you can use platinum or palladium in these catalytic converters, I believe there's a lot of substitution going on where car manufacturers are starting to use platinum instead of palladium. So that's one reason why I'm more bullish on platinum. I think there's also, this is kind of an outlier, but hydrogen fuel cell technology, if that were to gain traction, that's going to create additional demand for platinum. So I'm just more bullish on platinum than palladium, although I do like both.
Well, I appreciate you sharing. I'm still kind of trying to figure out what's going on with palladium, so that helps me a lot. And we also want to talk about uranium, and I think it's a good week to be doing this because we've seen some excitement with the US government and Cameco and Brookfield, that deal there. So I'll ask you, I think, to start out about uranium. Again, where are we in the cycle? Because we've seen some interesting ups and downs in the last years. Where are you seeing it right now?
Well, I think there's a lot of room to run in this bull market. I think the really easy money has been made. I remember scaling into uranium in 2020 when it was like $18 a pound, which made no sense. We've been as high as $107 last year, and right now we're hovering around $80 uranium. The price is still low. The price is still low to incentivize the new production that's going to be needed to meet the demand of all these reactors that are coming online around the world. Not to mention the still kind of unknown of how much data center demand that's going to create for nuclear as well, along with small modular reactors. So what I really like about this sector is it's a pure supply demand story, and the bottom line is the world needs more uranium, but the price is too low to mine it. It's incredibly volatile, and you can make a case maybe it's getting a little bit ahead of itself here. However, I think uranium is a smaller market than silver. And I mean, silver miners are incredibly volatile. You can make a lot of money in silver miners if you time it right. Well, the same is true, and even more so in uranium. I'm extremely bullish on uranium. It's had six or seven straight up months across the sector. It's getting a little bit overbought, some of the mining stocks, but I would be a buyer on any dips of uranium if you're, bullish on the fundamentals for that sector.
I think that's exactly what I was going to ask you. So the easy money has been made, but we've still got room to run. So what is your favored way to approach it? Are you going for something that gives you exposure to the price? Are you going for the large producers or a mix? How are you looking at it?
Yeah, unless you're highly skilled at individual stock selection, which is very difficult. There's two vehicles I really like. The Sprott Physical Uranium Trust, that gives you exposure just to the physical metal. I think that's the best risk reward way to play the sector. Probably not going to get like a 5-bagger on your money from here, but I think you can easily get a double or maybe more with relatively low downside risk. Another ETF I like is URNM. That's the Sprott Uranium Miners ETF. It's got about 15% exposure to the physical metal. And the next top two holdings are Cameco and Kazatomprom, which are the two largest producers in the world, and some exposures to some of those smaller and mid-tier producers. So URNM is an ETF that I feel like is a great vehicle just to get nice exposure to the sector. And then, of course, there's individual mining stocks for those inclined.
Yeah, absolutely. Absolutely. I think that makes sense. And I wonder, for the prices, I think we've seen spot and term prices essentially getting close to converging at this point. Do you have a long-term outlook for where the price of uranium could go?
I do. If you go back to 2007, the spike high was $147. That's on the futures price. If you adjust that for inflation using, of course, the government's flawed inflation data, that gives you a price target up near $200 adjusted for inflation. I think the fundamentals are more bullish now than they were on the last bull run. I think we're in a structural supply deficit that can only be exacerbated with oncoming AI data centers and small modular reactors and all of these things. It seems like every day the fundamental case for uranium just gets stronger and stronger. You just mentioned it was 2 days ago now that the U.S. government announced this $80 billion deal to fund, I believe, 10 new reactors, about 10 new Westinghouse reactors. So the fundamental case keeps getting stronger and stronger. But 147, I think that is a very logical target. If you want to adjust it for inflation, up near 200, and I think there's a decent probability we even take out that $200 high. But I'm not going to hold all of mine. I'll be scaling out along the way. But I think we probably ultimately go north of $200 uranium.
Right. I think you're absolutely correct there. It does seem like every day there's something that just adds to the positive side for uranium. All right. As we're getting to the end, I was wondering if there are any thoughts on the overall stock market that you would share, because I know part of the reason people are interested in gold, silver, precious metals is concerns about the general market and what we could have coming there in terms of a correction, maybe even a crash. So anything you're looking at there in terms of that?
There is, yeah. So from a fundamental basis, this is the most overvalued stock market in history. And there's multiple ways you can draw that conclusion. One I just was reading about this morning, the Buffett indicator is like the highest, most expensive stock market in all of history. But as we all know, bubbles can go on longer than many expect. So we know that we live in a boom bust cycle. The bust is sure to come. trying to time that is very difficult, but we can identify conditions that are ripe for a sharp stock market pullback. And I think those conditions are ripe right now. And that is one of the risk factors to, the sectors we're talking about here: silver, uranium, gold, platinum. If the stock market, I call it a deflationary impulse, if we were to have a big, sharp deflationary impulse, yes, those sectors would get taken down. But I also think they would be the first to rebound. And that's where that strategy is so much more important than predictions, and having some, I keep it separate, opportunity funded capital available. It's just sitting there. Yes, inflation is eroding its value, but when those, if you can buy when everyone else is selling, that's the times where, you can really get a bigger, a nice return on your capital. Buy when there's, when everyone else is fearful. So I guess the short answer is I do see a deflationary impulse coming probably in the next 12 months if I had to put a timeline on it. I think that could coincide with a spike in the dollar here. And if the dollar were to spike, there's the next deflationary impulse. How is the U.S. government going to react? The way they always react, with debt monetization, currency creation, stimulus, all those things on steroids. And I think that's what ultimately the reaction to the next deflationary impulse is what I believe ultimately sends silver to, up towards triple digits, gold up towards, north of $10,000, and these big targets that many silver and gold investors have had. I think the catalyst for that is the Fed's reaction to the next deflationary impulse.
Right. So it really all ties back together here, all the different themes that we've been talking about. This was really great. I will let you go, but before I do, any final thoughts that you would leave investors with if you want to talk about where we can find you or any other things that are in your head right now?
No, I think we covered everything. It was really great speaking with you and your audience. Silverchartist.com is the website. We've got a really low ticket service, nice community. It's a fully transparent, over the shoulder service with real time alerts. So you see exactly what I own. And every time I push the buy or sell button, our members get an alert. Not that I get everything perfectly, but everything's fully transparent. And the idea is that hopefully, we can keep each other sharp as we navigate these wild markets together. I'm also on X at Silverchartist. And, thank you so much for the opportunity to come speak with you.
Well, thank you as well. I think we covered a lot of ground. Great to have you, and hope to have you back soon in the future.
Absolutely. Thank you so much.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Steve Penny with silverchartist.com.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.